Hello students, welcome to SSMRV College video lectures and ISR initiative. SSMRV College, one of the premier institutes run by the prestigious RV group of institutions, has come up with a unique initiative to engage students at the time of this unforeseen medical emergency caused by corona outbreak. As a socially responsible institution, we would like to connect academically with students to make good the losses caused. In this connection, I, Pavana R. Kulkarni of Department of Business Administration, has posted a video on the subject Corporate Accounting and Reporting and the topic International Financial Reporting Standards. Please watch the video till end, like, share with your peer group and subscribe to our YouTube channel. We have completed the second unit, the financial statement analysis. Now we are moving towards the third unit. The unit heading is International Financial Reporting Standards. This unit is entirely theory. In this, you will be learning about the IFRS. Let us understand what is the meaning of IFRS. It is the abbreviation for International Financial Reporting Standards. So IFRS are the standards, nothing but rules, which guide us to prepare the financial statements. They serve as guidelines in preparation of financial statements. Such guidelines are called as IFRS. Now let us discuss about the characteristics or features of IFRS. IFRS has helped us to overcome manipulation of accounting. Manipulation of transactions used to happen earlier, but due to IFRS it has been avoided. These are based on economical value rather than legal value. Third feature states that the IFRS ignores historical cost concept and concentrate on current cost concept. When we follow current cost concept, our financial statements will be accurate. Fourth point states that IFRS has made it compulsory to prepare the financial statements according to Schedule 3 of Companies Act 2013. Every organization has to prepare the financial statements according to the Schedule 3 of Companies Act 2013. And it also states that depreciation should be charged on fixed asset till it disappears from the balance sheet. And last feature is each item will be expressed in percentage of total cost. Now let us understand the importance or relevance of IFRS in India. So Institute of Chartered Accountant has made some efforts to bring IFRS into existence, and these are commonly accepted accounting standards worldwide. So India also faced the same thing, so it made it compulsory. Many financial bodies of India had concern with the objectives of development of sound financial reporting standards, so they brought IFRS into existence, and it helps to integrate with law, customs and any business practices that are prevailing in India. So in India, the IFRS played a major role. Now let us discuss the advantages of IFRS. It facilitates for easy comparison of financial statements, because when we follow IFRS in India, every companies in India will follow same standards in reporting the financial statements, which helps for easy comparison. Second point, it gives more clarity than rule-based accounting, because every item must be recorded according to the standards. So it is more clear than historical accounting. Third point, common accounting and reporting standards worldwide. IFRS is compulsory for every company in every country. So it has made it compulsory to adopt in accounting. So common accounting and reporting standards are followed worldwide. improved access to international capital market. So every stock exchange wants the reports to be maintained under IFRS standards. So it improves access to capital market. So reduced cost of capital, double reporting, dual reporting, all are not followed in IFRS, which reduces the cost involved in it. And last one, it eliminates multiple reporting. Earlier multiple reporting was there in historical accounting. Due to IFRS, multiple reporting can be eradicated. So these are the advantages of IFRS. Now let's move on to disadvantages of IFRS. The drawbacks or disadvantages of IFRS are as follows. It is very expensive for small business enterprises. So many small businesses operating in India cannot adopt IFRS because it is costly in nature. Second one, it will need global consistency in auditing. Not only in accounting, auditing must be standardized globally, then only it is beneficial. Third point, it requires changes at educational level as well, because much education about IFRS standards is required. We are lagging behind in that, so it is a drawback. Increased workload for accountants. This IFRS standards are much complex in nature, which creates more burden on accountants, and it still requires global acceptance to be useful. So globally it should be accepted, then only it can be used successfully. Last point, it may lead to manipulation of standards. The standards set in IFRS may be manipulated by accountants. Then if it is manipulated, we cannot maintain uniform international accounting standards. These are the drawbacks or disadvantages of IFRS. The next concept is practical challenges faced by India in implementing IFRS. The first challenge is there was a wide gap between historical accounting standards and IFRS. So in order to cover a gap, it was not an easy task. Second one, increased responsibility. Every company made responsible to implement the IFRS. Third challenge is that there are still confusions in treatment of distributable profits in IFRS, which is a challenging factor. Fourth one, training and education. There is lack of training and academic courses relating to IFRS in India, because people are not getting educated about the IFRS standards. Next point, legal consideration. The regulatory and legal requirements in India was also challenging in implementing IFRS. Next point, taxation effect. The IFRS convergence will affect most of the items of financial statements, which also affects the tax liability. So it will affect the overall tax structure. Last one, fair value measurement. Fair value measurement. IFRS will use fair value as measuring base to value various items. Getting fair value, arriving at fair value is a difficult task. The next component is convergence with IFRS. Convergence means maintaining national accounting standards to prepare the financial statements. Every company should maintain national accounting standards while preparing the financial statements. Such thing is called as convergence with IFRS. What is the need behind convergence? First point states that globalization of Indian economy made every company to adopt national accounting standards. Second point, Indian companies listing in overseas stock exchanges made convergence with IFRS, because Indian companies used to list their stock also in overseas stock exchanges, when they are listing their securities, they have to maintain the accounting standards which are common for everyone. For that purpose, national accounting standards or convergence with IFRS came into existence. Third one, increased complexities in capital market. Many companies were dealing with capital markets, so there was a misunderstanding in accounting statements prepared by various companies. So this complexities made every nation to go for IFRS or convergence with IFRS. Now let us discuss very important concept of this unit, that is list of international financial reporting standards. They have listed some standards. First, IFRS 1 states that first time adoption of international financial reporting standards. This IFRS 1 should be followed by the companies whenever they want to implement the IFRS for the first time. IFRS 2, share based payment. When the companies are making their payment through shares, then they have to go for IFRS 2. IFRS 3 is for business combinations. When some business are merging or combining, then they have to go for IFRS 3. IFRS 4 is for insurance contracts taken by the companies. IFRS 5, non-current assets held by companies for sale and discontinued operations. Whenever they are selling non-current assets, then they have to go for IFRS 5. IFRS 6 is for the industries which are all engaged in mineral extraction of mineral resources. IFRS 7, it is for financial instrument disclosures. Every company has to disclose their financial reports according to IFRS 7. IFRS 8 is operating segment. For this, every company has to disclose their operating, that is financial activities conducted by them. IFRS 9, it is for financial instruments. Financial instruments held by the companies should be disclosed according to this standard. IFRS 10, it is for financial statements. Financial statements, whether it is true, it is giving the true and fair value, that should be stated according to this IFRS 10. IFRS 11 is for joint arrangements. What the companies are making whether the company is making some joint arrangements, whether it has combined its activity with any other company, that should be stated according to IFRS 11. IFRS 12 is for disclosure of interest in any other entities. If the company is having any interest in other entities, that must be disclosed. IFRS 13, fair value measurement. As I stated earlier, historical cost has been ignored. Current cost, which gives the fair value, that must be measured accordingly in IFRS 13. IFRS 14, it is regulatory deferral accounts. Any deferred revenue or expenses should be stated according to IFRS 14. These are the 14 IFRS standards which are very important. Please go through this IFRS standards. It will be asked for section C in your exams. So this is about IFRS unit. It is entirely theory unit. Please watch the video till end and like, share and subscribe. Thank you.